Something extraordinary is happening this week, and almost nobody outside Wall Street is paying attention. The U.S. government is about to flood the market with $119 billion in debt, testing the world's confidence in America's ability to borrow. But here's the shocking part. The very foreign buyers who once financed Washington's spending sprees are quietly pulling back. Instead of trusting America with decades of lending, they're only willing to loan money for a few months at a time. And when faith in U.S. debt starts cracking, the consequences don't stop in Washington. They hit your mortgage, your car loan, your job, and even the value of the dollar itself. If you care about how these decisions affect your wallet and the future of the U.S. economy, make sure to hit that subscribe button right now. We break down stories like this every week so you stay ahead of the curve. This week, the United States is putting its financial credibility on the line in a way that has global markets on edge. Washington is preparing to auction off $119 billion in new debt, $58 billion in 3-year notes, $39 billion in 10-year notes, and $22 billion in 30-year bonds. Normally, these sales pass quietly, just another step in financing America's bills. But this time, the situation feels different. For decades, the Treasury market was the world's safe haven. If a country or a global bank needed to store money, U.S. Treasuries were the answer. They were liquid, dependable, and backed by the full faith and credit of the U.S. government. But now, the very investors who once lined up to buy America's debt without hesitation are becoming cautious. Instead of committing to long-term bonds, they are piling into short-term Treasury bills, securities that mature in less than a year. It's like saying, "I'll lend you cash today, but I don't trust you for decades." That lack of long-term confidence has enormous implications. If demand weakens, yields rise. And when yields rise, the pain spreads quickly. Mortgage rates climb, car loans get pricier, credit card interest goes up, and businesses struggle to refinance debt. Even the U.S. dollar itself can come under pressure. That's why these auctions matter. They're not just technical events on Wall Street. They are direct tests of whether the world still trusts America to borrow and repay trillions, not just today, but for years to come. The problem is that trust is showing cracks. A decade ago, foreign governments and central banks were the backbone of America's debt market. In 2012, they held more than half of all U.S. Treasuries. Today, their share is closer to 1/4, a dramatic retreat that raises serious questions about who will fill the gap. Why are foreign buyers stepping back? There are 3 big reasons. First, the cost of hedging currency risk has soared. For a Japanese bank or a European insurer, buying U.S. debt now means paying so much to manage dollar exposure that it cancels out the yield advantage. Second, Washington has increasingly used the dollar as a political weapon. From sanctions to financial restrictions, other nations are realizing heavy dependence on Treasuries carries risks. And third, many countries see better opportunities at home. Japan, for example, is gradually raising interest rates, making Japanese bonds more attractive to local investors. The numbers confirm the trend. China, once the second largest holder of U.S. debt, has cut its position to around $760 billion, the lowest level in more than a decade. That puts it behind both Japan and the United Kingdom. Japan remains the largest holder, but even it has been trimming exposure as the yield gap narrows. This isn't a small adjustment, it's a structural change. And instead of locking into decades-long bonds, foreign investors are sticking with short-term bills. Here's the problem. Short-term demand keeps the system running, but it's also a sign of no confidence in America's long-term stability. Investors are saying, "We'll lend you money, but only if we can get it back quickly." That leaves someone else to carry the load, the Federal Reserve. Just last month, in only 4 trading days, the Fed quietly bought about $43 billion worth of treasuries. There was no press conference or grand announcement, but the scale of those purchases spoke volumes. This is striking because the Fed has spent 2 years insisting it's fighting inflation by raising rates and shrinking its balance sheet. Yet large treasury purchases look very similar to quantitative easing, the emergency bond buying program born during the 2008 crisis. If the Fed is already stepping in, it means natural demand is weaker than Washington admits. Private investors and foreign governments weren't buying enough, forcing the Fed to act as buyer of last resort. That raises a troubling question. What happens when an even larger wave of debt comes due? Because this isn't just about $119 billion this week. In 2025, The United States faces a rollover wall of roughly $9.2 trillion. Nearly 1/4 of the entire national debt will mature and need refinancing in a single year, on top of massive annual deficits. Already this fiscal year, Washington has posted a $1.6 trillion shortfall. Add in new spending programs and tax cuts, and the Treasury will need to issue even more bonds. Think about that scale. $9 trillion is more than the annual economic output of entire continents. Finding buyers for that much debt won't be easy, especially when traditional foreign demand is fading. And as supply floods the market, yields will rise unless new buyers step in. Signs of stress are already visible. Treasury auctions are open auditions for trust, and recent results have been shaky. At a 30-year bond sale, demand was so weak that Wall Street dealers, obligated to take the leftovers, had to absorb 18% of the issue, the highest share in years. Yields had to climb close to 5% to move the bonds. Another auction for 20-year notes came in with a bid-to-cover ratio of just 2.4, a soft showing for a market that once drew insatiable demand. Even the 10-year, the most watched benchmark, has wobbled, with yields near 4.7% as dealers quietly mopped up excess supply. Every weak auction has the same effect. The government must offer higher yields to attract buyers, and those higher yields don't stay in the bond market. They bleed into everything. The average interest rate on America's debt was just 1.6% in 2021. Today, it's about 3.3% and climbing. That doubling translates into enormous costs when applied to nearly $37 trillion in debt. By 2026, annual interest payments are projected to surpass $1.1 trillion, making it the single largest expense in the federal budget. Bigger than defense, bigger than Medicare, and growing faster than any other line item. Households are feeling the strain. Mortgage rates near 7% mean monthly payments are nearly double compared to a few years ago. First-time buyers are locked out, affordability has collapsed, and housing activity has slowed. Auto loans are pricier, credit card rates are higher, and companies that borrowed heavily during the era of cheap money are now staring at painful refinancing. Some will cut jobs, others will delay expansion. A few may not survive. This is why the Treasury market matters. Treasuries are not just government IOUs. They are the foundation of the global financial system. Every loan, every bond, every credit line is built on them. When the foundation shifts, the structure above becomes more fragile and more expensive. This has also revived a force many thought was gone: the bond vigilantes. These are investors who punish governments for reckless spending by dumping long-term bonds, forcing yields higher until policies change. That ghost is back. Long-term yields are rising faster than short-term ones, a signal that investors demand bigger premiums to finance America's future. We've already seen how this plays out. Earlier this year, when Washington announced sweeping tariffs, stocks fell, bond yields spiked, and the next round of tariffs was quietly shelved. The bond market forced policymakers to back down. Now the Federal Reserve is caught in a trap. If it steps in to stabilize the bond market by halting balance sheet runoff, restarting QE, or flooding the system with liquidity, it risks reigniting inflation and damaging credibility. But if it refuses to intervene and stays laser-focused on inflation, yields could spiral higher, choking off growth and driving borrowing costs through the roof. It's a lose-lose choice. You can control inflation, or you can finance the government cheaply, but not both at once. Where does this go from here? The answer depends on who shows up in the months ahead. The checkpoints are clear. Watch the auctions, watch foreign holdings, watch the Fed's balance sheet. If bid-to-cover ratios keep falling and yields keep rising, trust is slipping. If foreign holdings continue to decline, especially from China and Japan, the long end of the curve will grow lonelier. And if the Fed quietly expands purchases, it may be the clearest sign yet that natural demand has dried up. From here, three scenarios are possible. First, an orderly repricing. Yields drift higher, domestic buyers like pensions and banks step in, growth slows, but no crisis. Second, a stress episode. Auctions fail, the Fed intervenes, the dollar weakens, and global confidence wobbles. And third, a policy pivot. Washington imposes fiscal restraint, slows issuance, and stabilizes the market. Each path carries consequences for households, businesses, and investors alike. The big question remains: who will buy America's long-term debt? That single question will shape interest rates, inflation, and the dollar's role in the world for years to come. And that's why this week's auctions matter so much. They're not just another step in government finance. They are a referendum on confidence. Each bid, each yield, each week showing reveals how much trust is left in America's promises. For now, the system is holding, but the cracks are visible. And with $9 trillion rolling over next year, the real test is yet to come. Thanks for staying through this breakdown. What happens in the Treasury market isn't abstract. It affects your mortgage, your savings, your job, and the future of the U.S. economy. The auctions happening today are writing the story of tomorrow. And as the debt grows larger and buyers grow more cautious, the world is quietly asking whether America can still be trusted with the world's most important IOU. If you found this breakdown useful, make sure to subscribe and turn on notifications so you don't miss the next deep dive. The debt storm of 2025 is building fast, and staying informed could make all the difference.